Welcome to Apartment Market Dynamics and Happy New Year from MPF Research. He's Greg Willett, I'm Jay Parsons, and the way we like to celebrate New Year is by taking a look in the rearview mirror of the one that we just completed. And most of you probably know that the first 9 months of 2011 were very, very good for the U.S. apartment market. But what happened in fourth quarter? This is typically a pretty slow leasing period for the apartment sector, and going into fourth quarter, we were expecting to see pretty flat revenue change. And so, Greg, did we get a holiday surprise, or is this pretty much what we expected?
Again, we expected really not much of anything, and that's exactly what we got. Looking at the quarterly numbers, occupancy inched down 20 basis points, and effective rents came up 0.2%. So on net, revenues didn't change at all in fourth quarter.
And when you look a little deeper into the data, do we see any surprises among individual metros or any product sectors or anything that might give us some signs about momentum going forward?
Yeah, we did have a couple of regional trends that I think do tell us something about what's going to happen in the year ahead. And one of those was some significant slowdown in the Pacific Northwest in general, and particularly Seattle and San Jose took a hit with revenues actually coming down in those markets. On the other hand, we had the Texas markets really avoid the seasonal slowdown that they usually have, with some good numbers on the demand side. But really, probably the biggest factor there was we didn't deliver that many units in Texas compared to what we normally do in fourth quarter. So positive revenue changes in those markets during fourth quarter.
And let's shift the focus from fourth quarter specifically to 2011 as a whole. Demand in 2011 came in at 193,000 units. That is 3 times the total new supply total of about 66,000 units. Occupancy jumped 1.1 percentage points for the year and is now at 94.6%. That is a hair above the long-term average for the past decade or so, though still not quite back to those pre-recession peaks. And we're also seeing some good progress on the pricing side. We're going to show you a chart here. Effective rents for new leases climbed 4.7% in 2011, and that was enough to put average rental rates above the level seen prior to the recession back in late 2007. And that means that apartment operators are filling the hole that was dug through 2008 and 2009. And this is especially true at the top end of the market. In most places across the country, rents in the top half of the product spectrum are now well above those pre-recession rates, but there's still a good bit of work to do in the bottom end of the market to get them back to those pre-recession highs. So, Greg, I'm going to throw it back to you. Give us a run through of some of the top performers in the country on the rent growth side.
Yes, looking specifically at rent growth, and we are here going to focus on the major markets with at least 100,000 units. We'll bring up another chart for you. We love those charts. We will start with the Bay Area. Even though the Pacific Northwest didn't do especially well during fourth quarter, the calendar 2011 numbers were really rocking in the Bay Area on rent growth. Rents up just a hair under 15% in San Francisco, roughly 12% in San Jose, and 9% in Oakland. Moving on down the list, Boston saw pricing rise about 8%, and the increases were roughly 6 to 7% in New York, Austin, Pittsburgh, and Denver. So completing the top 10 list, and really we've got more than 10 because we've got a tie here at the bottom of the ranks here. We've got Seattle, Charlotte, Chicago, and Minneapolis, all with rent increases just a tick or two under 6%.
And I'll be the bearer of bad news and tell you the only market in the country that's still registering rent loss, surprise, surprise, Las Vegas. Same-store rents there inched down 0.4% in 2011. But even there, total revenues actually went up about 1% thanks to some occupancy growth. And the only other big market with revenue growth under the 2% mark was Virginia Beach, Norfolk, where rents and occupancy each went up about 0.5 percentage point. And those are both markets with obviously some unique challenges there. And Greg, in the bigger picture, we posted a video last week, or right before the holidays, about our expectations for 2012, and the general theme that we hit was more of the same. But for those who might not have seen that video, give us a recap of what we're expecting for next year, or this year.
Sure. Our forecast for 2012 is that we're going to see occupancy come up about 50 basis points, and that we will see rent growth of about 4.5%. As we were talking about some of these regional shifts, we do think that the momentum cools off a little bit in the Pacific Northwest, but really making up for that difference, we're going to have some accelerating growth in the Texas markets and a couple of other ones I'll throw in there to watch. Los Angeles should do better, and Atlanta, which has been struggling, should gain some momentum as well. So that's what gets us back up to that pretty strong revenue growth. Looking at some things that we're focusing on the operations side, we're certainly telling folks to pay attention to where they're pricing renewal leases versus new resident leases, because the gap between those is getting pretty big at this point. And then one other thing to pay attention to, really the middle market is expected to do pretty well this year with some strong occupancy increases and rent growth versus the top end of the market. We're already pretty much full there, and as we start raising rents a little bit more in that product, we're probably going to be pushing some people out of that top tier because of affordability considerations.
And Greg, I should point out that going into 2011, speaking of forecasts, you were probably a little more optimistic than most of us in the industry were. Your forecast for 2011, I believe, was 5.9% revenue growth, and that number turned out to be 5.8%. So off by 1/10 of a percentage point. Not bad at all.
We'll brag on that one. We usually do pretty well, but 1/10 of a percentage point might be the record for us.
It was probably a rounding issue. It's probably the
exactly,
same. Yeah.
Exactly.
So we'll see if we keep that momentum for 2012 in the forecasting category. So that wraps us up for this edition of Apartment Market Dynamics. Join us next time we start taking a look at individual metro performances from fourth quarter. So until then, for Greg Willett and for MPF Research, I'm Jay Parsons. Thank you for watching.
Want more? Go deeper with NPF Research's apartment market reports. From a national level, down to individual metros, to specific neighborhoods, NPF Research has been providing unparalleled apartment market intelligence to the multifamily industry for almost 5 decades. Learn more by contacting us at 877-284-4938 or visit www.npfresearch.com and click on Market Reports.